Hi, today we will discuss about the basics of financial planning. Now, what is the need for financial planning? I mean, it could be different for different people. It could be buying a house for somebody, it could be children's education, retirement savings, it could be a vacation, or it could just be unplanned expenses. Now, how does financial planning help you? I mean, it helps you to face exigencies, to achieve your goals smoothly, and most importantly, it helps you to secure your future, as in the case for retirement planning. Now, how do you plan your finances? Now, firstly, as far as savings is concerned, uh, you would have to maximize your savings, and savings is nothing but whatever you earn, and you deduct whatever your expenses are. So it is basically a function of income and expense. Thus, it is extremely essential to assess your fixed and variable expenses and accordingly plan your finances. And largely, it would be to minimize your variable expenses to maximize your savings. How do you calculate your taxable income? This is just a basic chart about the latest tax slabs which are there in India now. Now, what are the different tax saving tools which are basically available to somebody under Section 80C? I mean, there are up to a deduction of 1 lakh. Uh, there are various schemes which are available, such as Public Provident Fund (LIC), National Savings Certificates (ALSS), 5-year tax deposit, fixed deposit with bank and post office. Beyond ATC, you are allowed a medical insurance for self and for dependent children under Section 80D, and up to 20,000 rupees uh, for infrastructure bonds. Other than that, donations to specified mutual funds or specified funds or charitable institutions are also allowed. Then moving on to house rent allowance under Section 1013A. Now, HRA calculation is basically the least of the following: the actual HRA received from your employee, the actual rent paid by you for the house minus 10% of your salary, and 50% of your basic salary for metro, and 40% of your basic salary for people residing in non-metros. We also have home loans tax saving. The home loan provides tax benefits in two forms. One is the principal component under 80C and the interest component which is deducted under Section 24. Again, then we have leave travel allowance which can be used twice in a block of 4 years. Other than that, we have standard deduction of rupees 50,000 per annum, which is allowed. That's just to summarize the different types of tools which are there for savings and investments. You have insurance, which is basically your life and general insurance, mediclaim, auto, fire. You have mutual funds, again into equities, debt, balanced gold. You have company shares. You have government bonds and deposits, which is basically small savings like PPF, post office savings, APF. You have bank deposits, which could be recurring on fixed deposits and savings, and you have corporate and tax-free bonds, which is basically your HDFC, your Bajaj Finance, NHAI bonds. And then you have alternate investments, which could be in precious metals like diamonds, real estates, etc. Now, what is savings and what is investments? It is basically not the same thing. It is not how much money you make or how much money you keep, how hard it works for you, and how many generations you keep it for. Now, if you're a millionaire by the time you're 30, but blow it all up by the age of 40, you've gained nothing. Grow and protect your investment portfolio by carefully diversifying it, and you will find yourself funding many generations to come. Now, savings is basically not investing. A lot of people think that savings and investing is the same thing. Uh, I mean, you get salary saying I'm saving so much money, but is it the same? I don't think so. Savings basically means not spending your money, whereas investing means doing something with the money to earn a return. Now, savings must be done in a regular and disciplined manner, and investing has to be done with a lot of consideration. Where you put your money is equally important. As I said, you need to identify your goals. You need to prioritize, which is basically your top priority should be to pay down your existing debt if you have some kind of personal loans going on. So that your first top priority should be to pay off your existing debt, which is basically highest cost. It could be your credit card bills. Now, once you've done that, the next would be to create an emergency fund. Typically, we would advise somewhere between 3 to 6 months of a contingency fund for for your emergency needs. After that, you save for your retirement, and then you accumulate a down payment, for things like your house. You could build up a college fund for your children's education. And once all this is done, maybe you would set aside some money for some specific goals like a vacation or maybe buying a car, etc. The other important thing is you need to examine your spending habits. Keep a list of all your spendings for 1 month and compare the total spending to take home pay. Examine closely if you have a substantial unexplained gap, and thus try to know about all your expenses. Now, there are some basic principles to investment which one should keep in mind and follow. In finance, an investment is a monetary asset which is purchased with the idea that the asset will provide income in the future or appreciate and be sold at a higher price in the future. So, to do this, there are some basic principles that you need to follow. Firstly, you would have to diversify it, which basically means that don't put all your money into one type of investment. Then start early. Compound interest is the ninth wonder of the world. Who understands it earns it, who doesn't pays it, said Albert Einstein. So the faster, the earlier you start, the better. The higher the risk, the higher the potential returns. There are a lot of people who would talk about getting very high risk. I mean, guaranteed 20%, 25, 30%, 35% returns. And you have to keep in mind that The higher the return somebody guarantees you, the higher the risk that would be associated to earn that money. Don't let market slumps change your long-term investment plans. If you're invested in the stock markets, I mean, there would always be ups and downs. You know, there would be economic cycles. So your long-term investment plans should not be deterred by these short-term ups and downs. The other last principle, which I think a lot of people miss out, would be buy when the price is down and sell when the price is up. Typically, when everything is in the dumps, things are not good. Then people tend to just really sell off and exit. While when things look very good, the stock prices are very high. People, there's a lot of euphoria in the market, especially the retail investors. They start coming and buying at these very high levels. So I think this is something which you need to keep in mind. Now, just to give an example about investing early and giving time for your investments to grow over a period of time. Over here, you can see a chart above which shows the amount of money invested per month, you know, for a corpus of 1 crore at the age of 60. So if you see the amount of SIP that you have to do at the age of 25 and the amount of SIP that you have to do at the age of 45 is nearly 10x. And the other chart, if you see at the bottom of the page, it shows you the corpus created at the age of 60 for an investment of rupees 5,000 per month. You know, the, if you again over here see that if you start at the age of 25, then you know by investing just 5,000 rupees a month, you can accumulate a corpus of nearly 1.5 to 3 crores. Whereas if you just delay it by another 10 to 20 years, the corpus that you accumulate will become nearly 1/10. Now, here is just a comparison of where the various investment avenues vis-a-vis their average returns. Now, this table talks about the risk involved in investing. Uh, there are different types of risks which are there uh, in any kind of investing. One would be inflation risk, which is basically whatever money that you have, the value of money uh, that keeps coming down over a period of time. So you lose purchasing power. 100 rupees worth today would not be the same 5 years or 10 years down the line. That is inflation risk. Volatility risk would be instability of your investment. As I said previously also, which is basically that in the stock markets, there would be short-term ups and downs, which one has to bear with. So we have to be careful about stock markets being volatile in the short term. Uh, Other than that, would be you would have a business risk, which would be inherent risk for a particular business, a market risk, a likelihood that the market as a whole will fall. I mean, which could be to some extent macroeconomic related. It could be some decision like exchange rate or some government policy which affects the overall markets. Then liquidity risk would be not being able to access the money markets when needed. This would particularly be true for a lot of bonds which are illiquid, which you fail to sell when required. It could be a lot of small caps and mid cap stocks which don't generate enough volumes in the market. Interest rate risk would be the loss of principal on fixed rate investments due to rising interest rates. And lastly, I think currency risk would be the investment value affected by change in exchange rate between the currency of different countries. Now, how do you manage this risk? Inflation risk. The best way to mitigate inflation risk would be to invest in stocks. Keeping in mind that as with inflation, prices go up, the price of stocks or the products go up, invariably the price of the stocks will go up. So the best way to mitigate inflation would be to invest in stocks. Volatility risk, hold investments for long term. Business risk would be diversify within an asset class. Market risk, diversify amongst different asset classes. Liquidity risk, again, diversify among different asset classes. Have an emergency fund. Interest rate risk would be to ladder your portfolio so that again diversify in a sense that you have debt investments across maturity periods, 2 years, 3 years, 5 years, slightly long-term maturity. So that ladder your portfolio in such a manner that you mitigate interest rate risk to an extent. Currency risk, again, diversify amongst different countries or try and hedge your currency to an extent. Now, stocks have more volatility risk, which even out in the long run. Now, if we see that over a short period of time, uh, stocks would be highly volatile in the stock markets. But in general, if you see over a period of say 5 years, 7 years, 10 years, they tend to even out. And in general, we've seen that on an average, the stock markets tend to give you 12 to 15% annualized returns over a period of time, which even out. Now, what would influence your asset allocation? Again, your desired rate of return. If you're happy with 8% or 10% or 15%, that would make you decide whether to go in for a debt fund or a equity or stocks or maybe simple fixed deposits. Your risk tolerance, again, your ability to bear marginal loss or to bear fluctuations in the market, and your time horizon, whether you want to stay invested for 1 or 5 years or 15 years. In the shorter period, stocks, as I just said in the previous slide, that in 1 or 2 years, there could be a lot of volatility in stock markets. But if you take a time period of 15 years, we've always seen that we've made money from the stock markets. On the contrary, if you have a 1 year view, then it would be better to get into a liquid fund or a short term fund or maybe a fixed deposit which would give you a low return but guaranteed return in the very short period of time. Just some examples about asset allocation, how it can be different for different people, how it would be for a person, how it would change over a period of time with age. The kind of equity exposure that a person would take would be significantly higher when he's 30 years of age as compared to when maybe he would be 50, 55 years of age. Some key points to remember. Determine whether you have too much debt to develop a plan to conquer it. Nowadays, we heard a lot of credit card defaults. So basically, and loans, people not being able to repay their loans. So that is something which we have to keep in mind, that we have to have something in mind to ensure that we don't fall into a debt trap. Financial planning will help you clarify your goals, strategies, and actions. Learn as much as you can about investing to develop a plan and invest according to your comfort level. Make wise decisions about using debt. It's like buying a property, a house with debt is not the same as buying a car which is depreciable over time. So commit to savings and investments. And lastly, save and invest early. Again, nowadays, these are some things which we keep hearing all the time. Avoid fraud, and some things which just you need to keep in mind to ensure that you don't fall into any of these fraudulent schemes. Now, if somebody comes and tells you, just ask yourself does this investment sound too good to be true? As I said, somebody can come and tell you that guaranteed 25% returns, 30% returns. But if it sounds too good to be true, then stay clear, investigate, and ask questions. As I said, if somebody is saying 30% returns, just ask, how do you ensure 30% returns? Get written information, try and get a prospectus. Quick profits, inside information, and any pressure to invest quickly are signs of fraud. Verify the person selling the investment. And lastly, always pay through check and not cash, so that there's a trail as to whom you are paying the money. Again, moving to insurance. What is insurance? Insurance is a form of risk management which in which the insured transfers the cost of potential loss to another entity in exchange for a monetary compensation known as premium. So basically, again, just to repeat, insurance is not investment. Insurance is basically mitigating, it's a risk to protect you from uncertainties. Now, what are the different types of insurance? One would be non-life insurance, or general insurance, and life insurance. Under general insurance, you would be having medical and health insurance, motor insurance, and other types of insurance like uh, fire, theft, burglary, etc. Now, what are the tax benefits? Now, deduction is allowable for income of payment of life insurance premium aggregating to 1 lakh. Now, deductions under Section 80D, medical insurance up to 15,000, and income tax exempted on maturity or death claims proceeds under Section 10DD. 10D. Now, what is a mutual fund? Mutual fund is basically a pooling of money from investors to buy stocks, bonds, and other financial investments by any investment company for a predetermined investment objective. Now, there are different types of mutual funds which are there. It would be an equity fund, a debt fund, a balanced fund, which is a mix of equity and debt, and an ETF or an index fund. Over here, you can also see the kind of tax implications of investing in mutual funds. Now, what is a SIP? Nowadays, a lot of people talk about systematic investment plan. It's a perfect tool for wealth creation. This is a very important tool to iron out the fluctuation in the market and avoid timing the market. It helps in gradual accumulation of units over a period of time. It is a perfect tool for salaried people. This works well in uncertainties, volatile market conditions. And lastly, I think a combination of SIP, which is a systematic investment plan, STP, which is basically a systematic transfer plan, and a SWP, which is basically a systematic withdrawal plan, you can reduce your risk to a large extent. Now, how does SIP help you? It will help you in disciplined investing, wherein every month or every quarter you put in a certain amount of money, rupee cost averaging, which I mean over a period of time, as the price of the uh, plan or the stocks decline, you get to buy more units, and as the price of the stock goes up, you get to buy less units. So you average compounded returns. You can start with a very small amount as low as 5,000, 500 rupees, 1,000 rupees per month. Disciplined investing with forced savings. Now, SIP can also be a tax saving tool if it is done in an ELSS equity linked saving schemes. It is quite liquid with partial withdrawal, other than ELSS, which has a lock in period of 3 years. Now, debt investments, returns and implications. Now, there are different types of investments on the debt side which guarantee you a certain amount of returns. I think over here you can see the tax implication of the same. I think now a PPF, if your company is not paying you provident fund, is a very good option. Even better, employee provident fund, or if you want to add to it a voluntary provident fund, add it to your employee provident fund. You can go for. Then I think Sukanya Samriddhi is a very good product for a girl child. Then Senior Citizen Savings Scheme, again a product highly recommended for senior citizens. Up to 15 lakhs is allowed investment per person, senior citizen. The other, I think, important or significant investment avenue currently would be corporate bonds. And I think if you stick to good quality corporates like HDFC Limited, Bajaj Finance, etc., I think you can generate very good returns in excess of 8%. Thank you.